Good morning, students. In this lecture we will discuss about the derivatives, definition of derivatives, types of derivatives, that is futures, options, swaps, forwards, etc., and the conclusion. Now we discuss about the derivatives. First, introduction. The word derivative originates from mathematics and refers to variable which has been derived from another variable. That is, derivative does not have value of its own, but its value depends upon the variable from which it is derived. They are so called because they have no value of their own, because they derive their value from the value of some other assets which is known as underlying asset. For example, a derivative of shares of Infosys underlying will derive its value from the share price value of the Infosys. Similarly, a derivative of rice will derive its value from the value of rice. A derivative contract on soybean depends on price of soybean. That is, derivative is an asset which derive its value from the underlying asset, that is value of other assets from which it is derived. Definition: derivatives are specialized contracts which signify an agreement to buy or sell an underlying asset of the derivatives up to certain time in the future at a prearranged price known as exercise price. One of the oldest derivative is rice future, which have been traded on the Dojima Rice Exchange since the 18th century. As from the definition, it is clear that derivative are some specialized contracts which signify an agreement that we will buy an underlying asset of the derivative in certain future period of time and at a certain predetermined price, that is, price is also fixed in advance. The time at which it will be purchased or sold is also fixed in advance, and it is a future contract, that is, we will purchase the derivative of an underlying asset at certain future point of time and at a predetermined price, that is, we are hedging our risk. Example: a farmer fears that the price of soybean underlying when his crop is ready for delivery will be lower than his cost of production. That is, he wants to cover his risk because he thinks that the price will be lower than his cost of production. Let's say the cost of production is rupees 8,000 per ton. In order to overcome this uncertainty in selling price of his crop, he enters into a contract derivative with merchant who agrees to buy a crop at a certain price, exercise price, when the crop is ready in 5 months time expiry period. The merchant agrees to buy the crop at rupees 9,000 per ton. That is, farmer was of the opinion that after 5 months when his crop will be ready, there will be uncertainty, so he enters into a derivative contract with the merchant. The cost of production for the farmer was 8,000 and he agrees into contract with the merchant, and the merchant agrees to buy that crop at rupees 9,000 per ton after the expiry of 5 months, that is, in a future period, and the price is also settled, that is, at predetermined price of 9,000 per ton. Now the value of derivatives contract will increase as the price of soybean decreases and vice versa. For example, if the selling price of soybean goes down to rupees 7,000 per ton, the derivative contract will be more valuable to the farmer because the merchant will be giving him rupees 9,000. The cost of production was 8,000. Now the price has gone down to 7,000, but the farmer has covered his risk 5 months ago. He has sold his crops for rupees 9,000 per ton. Now he is beneficial. That is, this is because the farmer can sell the soybean which he has produced at rupees 9,000 per ton, even though the market price is very less, that is 7,000. That is, he has covered his risk. That is, he is not at loss, he is at profit. This is what is known as derivative contract. We can hedge our risk with the derivative contract. Types of derivatives: there are 3 types of derivatives: commodity derivatives, exchange traded derivatives, financial derivatives. As the name suggests, commodity derivatives are those derivatives when the underlying assets of the derivatives contract is certain commodity. That is, for example, if the underlying asset of the derivative contract is coffee, wheat, paper, cotton, gold, silver, precious stones, etc., then the derivative is known as commutative derivative. That is, the underlying asset of the derivative will be certain commodity. It may be rice, it may be wheat, it may be cotton. Financial derivative, as the name suggests, it is a derivative. The underlying asset of the derivative contract is financial asset. That is, the derivative price will depend upon certain financial asset, for example, debt instrument, currency price, index, equity shares, etc. Then the derivative is known as financial derivative. For example, if the derivative underlying asset of the derivative is shares of Tata Limited, then it will be known as financial derivative. Exchange traded derivatives. Certain derivative contracts that can be standardized and traded on stock exchange are known as exchange traded derivatives. There are certain derivatives which can be brought directly and the contract is direct between the buyer and the seller, for example forward contracts. But there are certain contracts in which stock exchange is involved. That is, we can trade only through these standard exchanges. That is, there is buyer, there is a standard exchange, then there will be a seller. The contract will be negotiated between the buyer and seller through standardized exchange. These are known as exchange traded derivatives. For example, future contracts. Will be studying these forward and future contract in the later slides. Now, basic derivatives. There are three types of basic derivatives: forward contracts, futures contracts, and options contracts. Now, forward contract. As I have already discussed, a forward contract is an agreement between two parties to buy or sell a commodity or financial instrument at a predetermined future date at a price agreed when the contract is entered into. That is, when we are entering a contract, we will be fixing the price and we will be fixing the date on which contract will be negotiated, and there is no middleman between in a forward contract. There is a direct contract between the buyer and the seller. Buyer will send the money to the seller on the predetermined date, and seller will then pay the commodity or send the commodity to the buyer, or buyer will get the possession of the commodity from the seller on that predetermined date. That is, there is no middleman or exchange involved in this contract. Features: price and date is predetermined in advance. Direct contract between buyer and seller, and there is no intermediary. For example, in the month of February, a mill owner agreed to buy the crop of soybean which is going to be ready in the month of September at a price of rupees 9,000 per ton. That is, mill owner agrees to buy from the farmer soybean at rupees 9,000 per ton. Now the farmer will get a price of rupees 9,000 per ton for his production, irrespective of the market price. That is, the farmer will be getting rupees 9,000 per ton, whatever may be the market price. If the market price is 7,000, farmer will be beneficial. If the market price is 10,000, then farmer will be at the loss and the mill owner will be beneficial. This is forward contract between the mill owner and the farmer, and there is no middleman involved in it. For example, mill owner will pay money, that is rupees 9,000 per ton to the farmer on the date of contract, and the farmer will transfer soybean to the mill owner at rupees 9,000 per ton, whatever may be the market price. Now, future contract. It is a refined form of forward contract. In the forward contract, we have studied that there was no middleman, but in the future contract there will be a middleman. That is, future contract is a refined form. There will be a fixed quantity, there will be a fixed quality, there will be a fixed price, and it will be traded through a traded stock exchange. That is, it is an agreement between two parties to exchange a commodity or financial asset for certain consideration after a specified period. It is standardized in terms of quantity, quality, and even terms of delivery. That is, I have already discussed that future contract is a standardized contract. There is standard fixed for quantity also, quality also, and even the terms of delivery also. The main feature of future contract is that it is traded through an organized stock exchange where it is properly regulated. For example, future contracts are standardized as regard to quantity, lot size, quality expiration, months, delivery terms, delivery dates, minimum and maximum price fluctuations, and even for trading days as hours. For example, buyer will give money to the exchange, stock exchange. Stock exchange will transfer that money to the seller. Then seller will transfer commodity to the stock exchange, and the stock exchange will transfer the commodity to the buyer. That is, there is a middleman between the buyer and seller, and the money and as well as exchange of commodity will took place through this stock exchange, because it is a standardized contract. Now, if the farmer is dealing through the stock exchange, out of 150 quintals he can sell 100 quintals through the stock exchange, because the lot is standardized and it is in the form of 100, 200, 300, and the 50 quintals which are left with the farmers is uncovered for price fluctuations. That is, he can enter into a derivative contract, that is future contract, for 100 quintals at a price of rupees 9,000 per ton, and delivery terms, delivery dates as well as minimum price will be those as specified by the stock exchange, that is National Commodity and Derivative Exchange Limited. This is what is future contract. Now, option. An option is a contract between two parties whereby one party acquires the right but not the obligation to buy or sell a particular commodity or financial asset or instrument at a specified price on or before the specified date. That is, option is that contract in which one party acquires only the right, but there is no obligation for him to buy or sell a particular commodity at a specified price or on a specified date. The person who acquires the right is known as option buyer or holder, while the counterparty is known as seller or writer. In return for giving such option to buyer, the seller charges an amount which is called option premium, because buyer is under a right, not an obligation. That is, buyer can refuse to deliver the commodity at a price fixed or at a specified time, because there is no obligation to deliver the contract in case of option. That's why the seller is charging a premium known as option premium. The specified price is called the exercise price or strike price. The commodity as financial asset covered by the contract is called the underlying commodity or financial asset. The specified date is called the maturity date or strike date. Now, types of option. There are two types of options, call option and put option. Call option. As the name suggests, call option is the option in which the option buyer has the right but not the obligation to buy the commodity at a predetermined price. That is, it means to call the item from the market. In other words, in this case, the option buyer will have the right and there will be no obligation on the option buyer to buy the commodity at the predetermined price on a specified date. For example, A enters into a contract with B whereby A has the right to purchase 100 quintals of wheat from B for rupees 1200 per quintals at any time prior to September 1st. For granting this option, A paid a premium of rupees 50 per quintal to B. This is called call option. Now, in this case, A will exercise a contract if market price of wheat is more than 1200 per quintal. That is, in this contract, A has entered into a contract that A will purchase 100 quintals of wheat from B for rupees 1200 per quintal at any time prior to September 1st. That is, before September 1st, he will be purchasing 100 quintals of wheat at a price of 1200 per quintal from B. Now, for this right, A has paid rupees 50 per quintal to B as option premium. Now, A will purchase that commodity only if the price of wheat is 1200 per quintal. If the price is less than 1200 per quintal, A can cancel this contract. This is what is known as call option. That is, there is no obligation, only the option buyer is having a right to purchase that commodity at a specified price and before the specified date. Now, put option, as the name suggests, In put option, buyer has the right to sell all the commodities at a predetermined price. That is, he has a right but not an obligation to sell the commodity at a predetermined price and before or on the specified date. That it means to put the commodity in the market. Now, in call option, he has a right to purchase, and in put option, he has a right to sell. For example, A enters into a contract with B whereby A has the right to sell 100 quintals of wheat to B for C at rupees 1220 per quintal at any time before September 1st. For granting him this option, A pays to B rupees 60 per quintal as premium. This is known as put option. Now A will exercise this option if the market price of the wheat is lower than rupees 1220 per quintal. That is, in this contract, A is entering into a contract with B where he will have a right to sell his 100 quintal of wheat to B at rupees 1220 per quintal at any time before September 1st. Now, there will be no obligation for A to sell this quantity if the price rises from 1220 per quintal. He will be selling that quantity only if the price is less than 1220 per quintal. This is known as put option. In the above two examples, A is the buyer, holder of the option, while B is the writer or grantor. The term writer is or grantor is used for original seller, while the term seller could refer to the reseller also. A third option is double option, in which the option buyer or holder of the option has the right, not obligation, to buy or sell the underlying commodity. That is, in this option, he will be having a right either to buy or sell. But in call option, he was having a right to buy only. In put option, he was having a right to sell only. But in double option, that is in third option, he has a right to buy as well as he has a right to sell also. For example, A enters into a contract with B to buy or sell 100 quintals of wheat at rupees 1200 per quintal at any time before September 1st. For granting this option, B charges a premium of rupees 110. Now here the important point is the premium for the double option is the sum of the premium of a call and put option and the same strike price for the same duration. That is, A can either sell or purchase the commodity to B or from B at rupees 1200 per quintal at any time before September 1st. Now American option. In this option, the option can be exercised at any time up to the maturity date according to the willingness of the holder or buyer of the option. This is a type of option in which option can be exercised any time up to maturity date. That is, it depends upon the willingness of the buyer of the option. That is, it is not necessary to exercise the option on the maturity date itself. It can be exercised at any time before the maturity date or on the maturity date. Now, European option. It is the option in which the option can be exercised only on maturity date. That is, if maturity date is 30th September, then option can be exercised only on 30th September, but it cannot be exercised before 30th September. Asian option. These are also known as average rate options and are very rare and do not have a final strike price. That is, no final strike price is fixed in this case. These options have a formula for determining the strike price, which would be the average of spot price over a given period of time. That is, the price at which option will be exercised is based on the average price. For example, on 1st August, the price of gold is rupees 2000 per gram. Mr. A is expecting a rise in price and buys an American option on gold with maturity date November 15th at a strike price of rupees 2000. The price of gold is subsequently as follows: 15th October rupees 2300, 15th November rupees 1800. In American option, A exercise it on October 15th and sell the gold at a profit of rupees 2300 minus 2000, that is 300. That is, on August the price was 2000. On 15th October, on which American option was taken on, the price is 2300. Now if the option is exercised, then A will get a profit of 2300 minus 2000 is equal to 300. If it is European option, then Mr. A can exercise its option only on maturity date, that is 15th November. As price is down on maturity date, A will not exercise this option because he will be suffering a loss of 200. That is, he has on 1st August the price was 2000. On the maturity date price is 1800. Then there will be a loss of 2000 minus 1800 is equal to 200 if he exercise this option. Hence, Mr. A will not exercise this option. Now there is a home assignment for the students. Write down the difference between forward and future contract. Also write down the difference between future and option. Thanks.